currencies themselves are credit. You find that economists think that currency is no longer credit. Currency is money. But they've got it entirely wrong because there is a counterparty risk. And the whole point about this debt trap is that we'll all be looking at the counterparty risk. You know, the US government and its dollar. What's this dollar backed by? Faith in the US government's finances. What faith do we have? Well, I'm sorry, it's disintegrating. So what does happen to the dollar? Well, just get rid of it. So I think the answer, quite simply, is possess gold, physical gold, or store it in vaults.
Gold prices are navigating a particularly intricate market landscape, influenced significantly by the Federal Reserve's current hawkish stance. The Fed's reluctance to implement rate cuts soon is a critical factor affecting the market dynamics. Concurrently, the descent in US Treasury yields holds significant sway over current market trends. As yields dwindle, the allure of gold heightens for investors seeking refuge in safe haven assets. This trend gains momentum against a backdrop of mounting concerns surrounding the banking sector's stability, as evidenced by recent developments at institutions like New York Community Bancorp. In response, investor sentiment is pivoting towards assets perceived as safer harbors during times of economic ambiguity, further intertwining gold's trajectory with broader market movements. Renowned analyst Alasdair Macleod expresses concern about the erosion of trust in the financial stability of governments, particularly highlighting the United States. We have seen that the diminishing faith in the US dollar, once considered the global commerce standard, stems from mounting debt levels and fiscal irresponsibility, which is another concern. Given recent harsh criticism of US currency policy by officials in China, Russia, Brazil, Saudi Arabia, and elsewhere, it may appear that the dollar's uncontested reign is ending, with far-reaching global economic consequences. Of course, this loss of confidence in the dollar's value, coupled with the inherent risks of counterparty default associated with fiat currencies, prompts Alasdair to advocate for a radical shift away from credit-based systems. Proposing an alternative, Alasdair suggests a return to what he terms true legal money, drawing upon historical precedents such as the legal systems of ancient Rome. He believes that physical gold is the perfect example of true legal money because governments or big organizations don't control its worth. This is very different from fiat currencies, which only have value if people trust the government that issues them. We will present clips from Alasdair Macleod's interview with Liberty and Finance. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
The problem, I think, is exacerbated because one of the largest holders is China. The other large holder, the second large holder, is Japan. Now, Japan has its own problems, which means that it has tended to reduce its exposure to US Treasuries because it requires the credit back at home. As far as China is concerned, you have an America which is belligerent over Taiwan, rightly or wrongly. I don't judge these things at all. I try and look at them even-handedly, but you can see that under those circumstances, China, is not really a very happy player in terms of going long dollars, going long more US Treasuries. Now, there is probably a price there to be met, but you may remember that Janet Yellen went over there sort of, 4 or 5 months ago and didn't really get anywhere. 5 Treasury officials, US Treasury officials, went over to Beijing to talk to the Chinese. The subject wasn't really mentioned except in airy-fairy terms, but you can bet your bottom dollar that it was actually about, come on, are you going to buy some of our US Treasury debt? What can we do to encourage you to buy some of our debt? And I guess that they probably came away with without really very, very much. Now, this is a real problem as far as America and the dollar is concerned, because the deficit is running away. You're in a debt trap. Interest rates are not going to come down, and we can talk about that in a moment if you wish. Interest rates, if they come down, it'll be one notch easier, and then they're going up again. They are going to go higher over the next 2 to 3 years. The Chinese know this. The Russians know this. And I'm sure that the US Treasury knows it, but it's trying desperately hard not to admit it. But so far, there has been no funding problem because money funds and also banks with their liquidity have basically been buying US T-bills. This is very short-term finance. It means that the general account at the Fed, when I looked at it a couple of days ago, was around about $800 billion. So they've got a little bit of cash in the till, as it were. But because they are spending so much in the economy, so much more than they're receiving in taxation, and there is no increase in savings. If anything, the savings, are going negative. Under these circumstances, there is inflation in the pipeline, this is yet to hit the streets. So, in the form of rising prices. So there is absolutely no way that the inflation problem is licked. If anything, it's going to get worse again. And that is why interest rates are not going to fall. So from the geopolitical point of view, put yourself in the shoes of the Chinese in particular. They can see that the yields on their current portfolio of US Treasuries are insufficient to reward them for the risk of holding them. They're not going to buy them at this level. But there is a problem with the debt trap, because if you raise the rate at which you're prepared to pay, then you're digging yourself into an even deeper hole and making yourself, if you like, rather like it's a sort of, find a simile. It was Groucho Marx who said, "I wouldn't join a club which would have me as a member," or words to that effect. It's the same sort of thing with this sort of debt, and this debt is unproductive.
Alasdair expresses concerns about the unsustainable economic situation in the U.S., predicting rising interest rates and suggesting that the current trajectory may lead to a deeper debt trap. According to the nonpartisan Congressional Budget Office, the United States is projected to add nearly $19 trillion to its national debt over the next decade, as the mounting costs of an aging population and higher interest expenses continue to weigh on the nation's fiscal outlook. From a geopolitical standpoint, Alasdair highlights that China and Russia recognize the risks of holding U.S. Treasuries at current yields. Meanwhile, Japan, grappling with its own economic challenges, has been reducing its exposure to U.S. Treasuries. Additionally, China's concerns about America's stance on Taiwan impact its willingness to continue investing in U.S. Treasuries. Despite discussions between U.S. and Chinese officials about increasing debt purchases, there has been minimal progress. According to Treasury International Capital data released by the U.S. Department of the Treasury on December 19th, China held a net $769.6 billion of U.S. government bonds as of the end of October, down $8.5 billion from the previous month. October marked the 7th consecutive month of declining purchases by China. The returns from China's current U.S. Treasury holdings may not justify the associated risks. If the U.S. offers higher interest rates to attract buyers, it could further exacerbate America's debt problem. Let's get back to the interview.
Well, the only thing to do, I've said it many times before, is just get the hell out of credit. Now, so what is credit? Credit is not only just bank accounts, where the bank owes you money. You have money on deposit. It's not your money. It's the bank's obligation to pay you your money, or in fact, it's not money. It'll be by another credit, which you can then deploy for buying goods and services. Currencies themselves are credit. You find that economists think that currency is no longer credit. Currency is money. But they've got it entirely wrong, because there is a counterparty risk. And the whole point about this debt trap is that we'll all be looking at the counterparty risk. The US government and its dollar. What's this dollar backed by? Faith in the US government's finances. What faith do we have? Well, I'm sorry, it's disintegrating. So what does happen to the dollar? Well, just get rid of it. And, the problem, I think, for financial markets is that you get rid of the dollar. What do you get rid of it for? Yen? Pounds? Euros? They're all in the same boat. So the only answer, basically, is true legal money, which has been legal money ever since Rome's 12 tables back in 548 BC, I think it was, or 49 BC. So we're talking about a very long history, incorporated in law, in all our laws, because we are all successors to the Roman Empire, and we have adopted their laws in this respect, certainly, as the backbone for our common law. And this is why, if you look at the Fed's balance sheet, you still see that the gold note, which is an obligation from the US Treasury to the Fed, is valued at $42.22 an ounce. There has to be an official rate. That's the official rate. I know it's complete rubbish, but that's the official rate. In this country, we have coins, sovereign coins, which are still money, and the reason there is no tax on them is because they are money. You don't tax money. You tax, you tax profits, or you tax capital gains, or you confiscate. So if they were going to confiscate gold, let's say, in this country, they would have to exchange it legally, one sovereign for £1. Well, I can tell you at the moment, it's £400 for one sovereign. So that's not a deal anyone's going to go for. I mean, and if they were going to do in America, if they were going to do an FDR swap, where you were forced to cash in, it wasn't confiscated. You were forced to submit your gold and your gold notes for federal notes. In other words, it was a swap. At that time, it was 20.67 to the ounce. If they did it again, they'd have to say, look, Dunnigan, you've got to submit your gold, but it'll be at $22 an ounce. Are you going to be happy about it? There's absolutely, that really does become confiscation by another route. And then we're in a whole new legal ball game. It's not going to be so easy this time as it was when there was an operating gold standard, and you could do it by executive order. So I think the answer, quite simply, is possess gold, physical gold, or store it in vaults outside your country, which is actually what we do at Gold Money for so many of our American customers. And it's all about getting out of credit, really. You're not buying gold because you love gold. You're buying gold because you don't want to be in the same situation. They're the Chinese looking at the dollar. You should also be looking at it in exactly the same way and thinking, is this something that I actually want to be a part of?
A soft landing is now widely anticipated, indicating that the opportunity cost could emerge as a potential driver of gold prices. In this context, the Federal Reserve may find itself positioned to reduce interest rates and lower U.S. bond yields. Consequently, gold, a non-income producing asset, becomes relatively more attractive, thus solidifying its status as a safe haven. We would love your thoughts on Alasdair's predictions in the comments below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.